Hi guys, welcome to my channel. So before we get started, make sure to hit the like button, also subscribe to my channel. Investing versus gambling, so make sure to watch the full video. There's no doubt that investing can be exciting. A quick win on the markets can make you feel buoyed up and hooked on finding the next opportunity. But there's a fine line between investing and gambling, and you need to be sure you're on the right side of it. In March, stocks globally fell at least 25%, and 30% in most G20 nations, though they later recovered much of the lost ground. Then we entered lockdown, a period of home isolation, and for those not furloughed, surplus spending income. A combination of eating at home, a shuttered hospitality industry, and barriers to overseas holidays translated into big savings. With the Office for National Statistics revealing that we saved £15 billion in just 3 months. But many people did not just put it into the bank. Under lockdown, there was a striking rise in the number of 25 to 34-year-olds discovering investing. Novice investors flooded the markets in March and April, hoping to profit from the market lows and perhaps relieve some of the lockdown boredom. In the second quarter of 2020, this age group saw the strongest growth of new ISA and self-invested personal pension (SIP) account openings with Interactive Investor, up 275% and 258% year-on-year respectively. Younger cohorts were drawn to the biggest tech stocks. Apple and Amazon featured among the top 10 stocks held by millennials on Interactive Investor in April, and exchange-traded funds, the low-cost, highly tradable collective investments. Those buying Amazon at the start of April at $1,901 a share saw the price rise steadily to $3,531 by September 2, a gain of 85%. Over the same period, Apple had an even more impressive trajectory, rising from $60 to $134, up 123%. Doubling your money in a short period is undoubtedly thrilling. The risks of buying stocks and shares, what goes up can also come down, are widely known. However, some platforms promote investments that carry a considerably higher level of risk. One is the contract for difference, CFD, a bet on short-term share price moves and a popular form of derivative marketed to amateur UK investors. A regulatory review of the market in 2016 found 82% of investors lost money on CFD. The regulator ultimately imposed stricter caps on the market to protect consumers, but risks remain. If you've been tempted to use CFD and subsequently lost or won money or experienced it, hi, you're likely to be gambling rather than investing, and that is not a great foundation for financial security. The difference between investing and gambling isn't always clear-cut. Both involve risking money for potential financial gain. Some professional gamblers have tried and tested systems, while some investors are actually gambling without realizing it. But my favorite explanation of the difference is in their willingness to accept risk. Are you taking just the risks you should take, or are you taking more? Would you rather have £100 or a 50/50 chance at £200? If you take the £100, you're an investor. If you go all or nothing, you're a gambler. Put differently, would you rather put your money under your mattress or in an extremely volatile stock that could become worthless overnight or double in value? If you expect to double your money quickly, you are probably gambling, even if you are buying a well-known company on the London Stock Exchange, rather than using CFD or playing blackjack in an online casino. The best investors advocate a slow and steady route to investing success, picking a well-diversified portfolio of investments from different sectors and regions to hold for the long term. Investing regular amounts on a monthly basis and reinvesting dividends are also tried and tested methods of building wealth. I can remember a reader's portfolio from my time as a journalist on the Investor's Chronicle that was stuffed full of high-risk oil stocks. He was in his late 20s, had a few £1,000s invested, and wanted to make $1 million by age 40. The overly ambitious target and his get-rich-quick approach set alarm bells ringing. We recommended he have a serious rethink. Warren Buffett, the veteran investor, was interviewed by CNBC in early 2018, at a time when many so-called investors were borrowing money to purchase stocks and cryptocurrencies or loading up on exotic investments. He warned investors about treating the stock market like a casino and instead advised patient investment in companies with products that already have strong sales and a record of delivering profits. "A lot of people like to gamble in the stock market," he said. "It is insane. To risk starting all over again and losing everything is madness." Some blame the way we teach investing at home or in the limited ways some schools teach the subject. It's a conundrum. To get children interested in the subject, we can't make it boring. In share-picking contests, often held over the course of a few weeks or months, the winners are unlikely to be the kids who build responsible portfolios. In truth, investing should be like watching paint dry, but this is hardly going to help children develop a lifelong interest in the subject, or wean them away from Fortnite to the Financial Times. As part of my stock market summer school, I set my daughter a challenge to get her guinea pigs to pick stocks. They nibbled at the carrots next to ITV and Lloyd's Banking Group, and we've been following their progress every week. What I can't do is tell a 10-year-old that we have to wait 5 years to find out which pet has won. Instead, my aim is to show that investments can fluctuate over the short term, and to emphasize that with real money she'd need to put it aside for a long time, and in more than 2 stocks, there are ways of communicating the vital lessons of investing without creating a new generation of gamblers. Gambling is not a healthy habit, and it is high time individuals recognize this. Gambling doesn't allow you to plan and direct your funds appropriately, especially when it's an addiction. To turn this around, one should consider investing, particularly so that you can secure a future for yourself. There are many investment opportunities such as stocks, fixed income securities, and collective investment schemes, such as money market funds, which will give you a return while preserving your capital. However, the question remains, isn't investing the same as gambling? Not exactly. Investing and gambling both include some level of risk, which the involved parties choose to accept. For this reason, the two are sometimes thought to be similar. However, in reality, they are quite different. Firstly, the element of risk is presented differently. Case in point, with investing, the level of risk can be reduced by diversifying your portfolio and spreading your funds across various asset classes, such as equities, real estate, and fixed income. This way, when one of the asset classes is exposed to risk, the others will dilute the amount of loss that is expected, as only a percentage of the funds are impacted and not the entire capital base. On the other hand, gambling risk cannot be spread, which puts one's entire funds in jeopardy. Similarly, access to information is different. In investments, you have access to all the information needed to make an investment decision. This lets you analyze the various types of investments, and you can use historical data to establish a trend project's future performance. This privilege allows you to find ways to mitigate risk as well as reduce the uncertainty surrounding investing. Meanwhile, with gambling, the gambling agencies are not required to disclose any information to you, which forces you to go in blind, hoping for the best but preparing for the worst. Moreover, investing and gambling have different time frames of viability. For instance, once invested, you have to wait a certain period before you begin receiving gains from the investment. It can also become an alternative income stream, which you can receive as monthly interest payments. You can also benefit from capital gains, as in the case of equities. On the other hand, gambling is a one-off event where you make a bet and expect to receive the gains immediately after the event. Furthermore, the gains of a gambler come in lump sum, whereby there will be no income stream after the initial gain. Besides, gambling is a zero-sum game where you are always playing against the house or a fellow player, and one has to lose for the other to win. This increases the level of risk, as you do not know what tactics your opponent will use, especially if it is a casino. Therefore, your wins are mostly out of luck. On the other hand, with investing, all parties can win, where in the case of stocks, all stocks in a certain exchange can increase in price, rewarding investors of various companies with capital gains. Therefore, you are not forced to anticipate the move of other investors, and you can focus on your strategies. In conclusion, both investing and gambling have a possibility of risk and wins, but where investing allows you a choice of what will happen to your funds, Gambling is a game of chance. Therefore, you would be better off choosing an option that discloses information on the expected outcome than one that relies on luck. To control the gambling addiction, consider signing up for a personal finance class. 1. Investing is based on research, while gambling depends on luck. Investing is an activity which requires much research. Gambling solely hinges on emotions. One needs to do enough research and understand the risk tolerance, goals, and financial situation to invest in the right assets. Gambling, on the other hand, doesn't require much research. It's just one news that breaks through the market, and it's the emotions that control the market. However, people often invest based on tips or rumors and research to gamble sometimes. To buy a futures contract, one might do more research than buying stock itself. So there is a thin line between the two. Hence, people often mistake investing with gambling. 2. Investing gives ownership of an asset gambling doesn't. Investing in mutual funds or shares, or any asset for that matter, does provide us with ownership of the asset. In gambling, when you put your money, all you receive is more money or no money. There is no ownership of an asset that comes at the end of a gambling transaction. However, in investing, one can claim ownership of an asset. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.